In the world of finance, two powerful forces vie for your attention. On one side, the impenetrable fortress of a high-yield savings account, promising safety and stability. On the other, the dynamic, ever-shifting landscape of exchange-traded funds, offering the thrill of growth. But which one is right for your financial journey? Today, we're staging the ultimate financial showdown, HISAs versus ETFs. It's not just about picking a winner, it's about finding the perfect ally for your unique goals. So, grab your financial compass, because we're about to explore these two distinct paths to managing your money. First up, let's meet our first contender, the high-yield savings account, or HISA. Imagine your money resting in a secure vault, guarded by the unwavering HISA guardian. The primary advantage here is safety. Your funds are FDIC insured up to $250,000, meaning your principal is protected from market turmoil. This makes HISAs an exceptionally safe harbor for your cash. Furthermore, they offer remarkable liquidity. Need your money for an emergency? You can access it quickly, often with just a few clicks or a trip to an ATM. This combination of security and accessibility makes them a fortress for your short-term savings. However, every fortress has its vulnerability. The HISA guardian's primary foe is inflation. While your money is safe, its purchasing power can erode over time. Imagine watching a loaf of bread slowly shrink year after year. That's inflation at work. HISAs offer better interest rates than traditional savings accounts, but these returns often struggle to outpace the rising cost of living. The guardian watches with concern as the glow of your savings slightly diminishes, a reminder that while your money is secure, it may not be growing in real terms. For this reason, relying solely on an HISA for long-term wealth building can be a slow and arduous path. Now, let's turn our attention to the challenger, the exchange-traded fund, or ETF. Picture the ETF weaver, a masterful artist gracefully weaving together countless streams of light, each representing a different company or asset. This is the power of diversification. Instead of betting on a single stock, an ETF holds a basket of investments, stocks, bonds, or commodities, spreading your risk across a wide array of holdings. This inherent diversification is one of its greatest strengths. The weaver's tapestry expands and brightens, symbolizing the potential for significant market growth over the long term, making ETFs a powerful tool for building substantial wealth. But the weaver's art is subject to the unpredictable winds of the market. The streams of light can flicker and dim, creating a volatile pattern of peaks and valleys. This is market risk. The value of your ETF can fluctuate daily, sometimes dramatically, much like a thrilling but stomach-churning roller coaster ride. While long-term trends often point upward, there's no guarantee of returns, and you could lose money, especially if you need to sell during a downturn. The ETF weaver's creation is a testament to both incredible potential and inherent risk, requiring a steady hand and a long-term perspective from the investor. So how do you choose? Let's break it down in a head-to-head comparison. When it comes to risk, HISAs are very low risk, while the risk for ETFs varies from moderate to high depending on the underlying assets. For potential returns, HISAs offer lower but stable interest, whereas ETFs provide the potential for much higher returns. This leads us to their ideal use cases. HISAs are best for short-term goals like building an emergency fund, saving for a down payment, or stashing cash for an upcoming large purchase. ETFs, on the other hand, are tailor-made for long-term wealth accumulation, such as retirement planning or funding a child's education years down the line. In the end, this financial showdown doesn't have to have a single victor. The wisest strategy often involves employing both. Imagine the HISA guardian and the ETF weaver shaking hands, combining their strengths to create a balanced and resilient financial plan. Your emergency fund can rest securely in an HISA, while your long-term investments work hard for you in a diversified ETF portfolio. The key isn't choosing one over the other, but understanding how each tool can serve you best. By aligning your choice with your personal goals, timeline, and risk tolerance, you can build a financial future that is both secure and poised for growth.